A cooling cycle is hitting the AI hardware supply chain, and the signal came through in semiconductor leads, while the broader market barely blinked. The question isn't whether this is a sector rotation or a warning. What matters is where your portfolio exposures sits as capital migrates from optics infrastructure toward application layer earnings. The speculative appetite is cooling with precision, not panic. SPHB dipped 113% while ARKK remained flat at 79.64 cents, suggesting smart money is trimming speculative positions rather than fleeing en masse. The Mag7 proxy MAUGs pulled back slightly but still sits positive, confirming that mega-cap tech fundamentals remain intact even as mid-tier hardware suppliers feel the pressure from application layer consolidation. Regional banking showed unexpected resilience with KRE, climbing 1.24% to $75.80, while larger regional intermediaries like SPHB absorbed some rotation, the tokenization headline. DTCC executing first live trades on Wall Street assets created minor volatility but minimal real impact. This structural shift explains the quiet noise in sector ETFs. Capital is repositioning rather than rotating out of credit entirely. VIXY and UVXY both compressed significantly, dropping 2.48% and 3.81%, respectively, to trade near $20 and $22.72. The VIX itself fell 5.04% to 15.67, confirming fear has already priced in the AI hardware slowdown. This compression suggests institutional positioning is defensive but not panicked. The cardiac monitor shows steady rhythm rather than arrhythmia. Applied optoelectronics shedding 12%, and Lumentum sliding confirms the optics trade cycle is entering its seasonal correction phase after running hot through Q1 earnings. The tech headline dominance. 15 mentions versus geopolitics at just 5 indicates corporate fundamentals are still the primary price discovery mechanism, with AI cooling serving as a rotation catalyst rather than a structural threat. TLT gained 0.23% to $84.20, while GLD remained essentially flat, suggesting defensive positioning is active but selective. The bond proxy moved up 0.25%, confirming that yield-seeking capital has already priced in the inflation cooling narrative. Safety hasn't become a flight response. It's a measured repositioning as uncertainty around AI application timelines extends into Q3 earnings season. The portfolio hero faces no immediate threat from this cycle. Instead, it needs to trim speculative exposure while maintaining core tech positions. The villain today is sector concentration in optics infrastructure, not the broader AI thesis or bankingflation trajectory. VIX compression and regional strength signal that institutional positioning remains constructive, despite the hardware slowdown. The verdict: sector rotation into application layer earnings, with defensive positioning active but selective. Keep allocation weight toward mega-cap tech, while trimming mid-tier hardware exposure as Q3. Earnings validate whether this is a cyclical correction or structural repositioning. The Canary dashboard shows steady vital signs. Monitor optics infrastructure closely, but the broader respiratory function remains healthy.